Major funding for these programs is provided by grants from HSH Nordbank and First American Title Insurance Company of New York, Perfect Building Maintenance, SJP Properties, Murray Hill Properties, Bank of America, Greenberg Traurig, Allied Partners. Additional funding is provided by grants from Arbor Realty Trust and Terry's Investment Partners, Athena Group, BRT Realty Trust, Burden LLP, CB Richard Ellis, City Habitats, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, Essex Capital Partners, Herbert J. Sims & Company, Herrick Feinstein LLP, Helmsley Spear, Jackson Development Group, James D. Kuhn Real Estate Institute at Syracuse University, Kilroy Metal Products, Massey Knackle Realty Services, M&T Bank, Madison Realty Capital, Marcus and Millichap, Meriden Capital Group, McSam Hotel Group, Newmark Knight Frank, Moynihan Organization, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sidney Fettner Associates, Sheldrake Organization, Stonehenge Partners, Studley, Triangle Services, Witkoff Group, Extreme Contracting and Deconstruction.
Hello, my name is Michael Stoller, host of the Stoller Report, Real Estate Trends in the Tri-State Region. You know, there's a credit crisis, but there's a lot of money out there for what we call equity. And today I have an interesting group of guys. I have operators, real estate operators who have raised funds to be investors. So they have the opportunity to have money available to use as equity for deals. My guest today is a returnee. He's been with me before, Charles Bendit, principal at Taconic Investment Partners. David Welsh, who is a founding managing partner at Normandy Real Estate Partners. And last but not least, Nick Beanstalk, who is a managing principal partner at Savannah Partners. So all of a sudden, you guys, I think you're probably in the business longer than all of them. I mean, in both ways. I mean, we won't talk about our age, but no, I mean, Taconic has made some great investments. I mean, 450 Park Avenue, 111 8th Avenue. Now you're raising a fund, and that fund is going to be used to do what type of developments today?
Well. We went out to the marketplace with a value-added type of strategy to buy properties, turn them around, buy sites, and develop them. That was a year and a half ago when we started thinking about what we wanted to do, but the market's changed. We think that there'll be very good buying opportunities for buying real estate, but I think we needed to be, we're a little bit more expansive now. We're looking at debt opportunities. But our focus as an operator has always been, if we're going to buy a loan, there's an end game. Not necessarily to be the lender, but maybe an opportunity to buy something with the opportunity to own it at some point in time. Right,
but recently, I mean, you've done two very interesting deals. I mean, in December, you closed on the acquisition of 375 Pearl Street, right. Which was the Verizon building, you know, one of the ugly Verizon buildings that you're recladding and you're changing everything about that. And then I think in February you bought the American Banknote building.
Actually December. It was a busy December.
Busy December, okay. And you know, that's like a funky neighborhood. It's a good alternative for the Bronx, maybe good for a variety of things. So you've been active over there.
Well, again, those were what our core strategy has been, which was the value-added play. When we bought the Verizon building, it was on the basis that we would be in for $160 a square foot for a built building. Land was trading, office building land, residential land, but office building land, which this was going to be an office building, was trading at $300 a square foot for great land. So we felt if we could reclad this building and create a Class A building and be in for 2/3 of what a brand new building would be for, that was a very interesting value proposition. The banknote building was a little bit of a different strategy, more of a defensive strategy. We bought a building for $70 a square foot that was 50% leased. It's a light industrial building, and we looked at it as an adaptive reuse, like what we did in Chicago or what we did at 111 8th Avenue. It's transforming something into a different type of property. In this case, a loft-type office property. And what we saw was a chance to take something, fix it up, great bones, in a good location, fix it up and be able to deliver product to tenants in the $25 to $27 a foot range, and after the incentives, effective rents would be about $8 to $12 a square foot. There are a lot of tenants in New York City, particularly in Manhattan, that are being priced out of Manhattan. They're facing lease expirations where their new rents will be $40, $50, $60 a square foot, and those tenants just can't afford to be in that kind of space. So we looked at this as an opportunity for those tenants to find great space in an accessible location,
right,
a value proposition.
Great. And you, the man from New Jersey, I mean, Morristown, so, I mean, you've been an investor, now what type of deals are you looking to do, and what do you see in this marketplace?
Yeah, we're much the same as strategy as Nick and Charlie. We started investing in 2005, our first fund. We manage and invest on behalf of two funds, excuse me. And just recently, in 2007, we started shifting our focus away from a diversified equity portfolio, primarily office, suburban office, to now buying at a lower point in the capital stack. So we're doing preferred equity, buying distressed debt, non-performing loans, sub-performing loans.
But you have a large New Jersey office building portfolio, don't you?
Yeah, we the majority of our portfolio, believe it or not, is suburban and downtown Boston. We have 8 million square feet of commercial space, about 4 million of that in the Boston region, a few million square feet in Northern Virginia and D.C., and a couple million square feet in New Jersey. And then in the New York area, we have an apartment portfolio in the outer boroughs and some office buildings in Westchester and Fairfield County.
And how is the Westchester office buildings today?
We have one asset there. I mean, it's much of the same as New York. I mean, I think of the last year or so, the surrounding suburbs of New York haven't really experienced the rise that Manhattan has. So it's been fairly inactive.
Mm. And you, the newest fund guy, I mean, you've been always an operator, the Savannah Partners, for a number of years.
We've been long-term owner-operators. We raised a fund starting in 2006, but we closed it at the end of 2007, $313 million. I think sometimes better lucky than smart. I think we were fortunate to raise a lot of money, but not invest it prior to the credit crunch. So we've actually been investing fairly consistently since the credit crunch, and really see the opportunities a lot where you do, which is we've been buying debt from the banks, we've been buying B notes, mezz loans at a discount, and assets to where we think the asset isn't impaired. The baby's kind of being thrown out with the bathwater, and the asset isn't impaired, but the bank, unfortunately, is in crisis.
All right, but you're also doing right across the street from Madison Square Garden and the post office. You're building what?
We're building 100,000 square foot ground up, 90 apartment units, over 18,000 square feet of retail. So it's right across from the new Farley Post Office, Moynihan Station, diagonally across the street from Madison Square Garden, a corner site. And we're in the market actually right now for construction loan right now. And I think had we been in the market for construction loan on sort of core site opposite one of the busiest transportation hubs in the United States, a year ago we would have gone out to 30 lenders and gotten 30 term sheets. Today I think we got 5 term sheets, and we're negotiating with 2.
And what do you feel your rents are going to be for residential? Because we got the Charlie's deal that he did.
On the residential side, I think between $72 and $74 a foot. Right. We've comped that out. So I think that's where we're hoping to be.
And you had a very successful the Caledonia.
Right. That was 190 condos,
right,
and 288 rentals. The condos sold out quickly. We sold out in about 8 months. and that was about a year and a half ago. We probably could sell for more. Our average price there was $1,400 a square foot. I think we could probably sell for $1,700 a square foot today. Actually, there have been a couple of buyers that have come to us and said, would you mind if we flipped it? And we have an anti-flip clause in the contract. So, you know, we'll work with buyers and share in profits, whatever. But the 288 rentals, we had...
Is that an 80-20?
That's an 80-20, exactly.
For my audience, 20% affordable.
That's right, 20% affordable. The market rate units, we had projected $67 a foot in rent. We're getting 86.
Wow. Wow.
That's, to put it into perspective, we're getting $7,500 for a two-bedroom apartment, $4,800 for a one-bedroom apartment.
Right.
So it's doing remarkably
so
well.
Even in this credit crisis, you know, people are still paying rents, but there's a selective. People want to be. That's a unique location, and you know, even on your location, Hal Fettner has been on the show. You know, when he and Doug Durst built the building
Street.
over there in the middle of, they never expected to get more than $48 a square foot, and they're getting $60 a square
But
foot.
you've got sub 1% rent. I mean, the rental market in Manhattan is its own animal. I mean, it runs on you know, there's tremendous demand. And over in that location, you have FIT, you have, you know, the transportation network. You know, people are...
No, they're, you know what, it's also 90 apartments. It's not going to be that difficult to rent because there's a need. There are people over there. I mean, my friend Ofer Yordeni, when he bought the building, which was the Penmark, which he recladded the Olivia, he's doubled the rent since he has had the property. I mean, Manhattan is an island. Let's talk about, you know, you went to the Bronx, you have things in Brooklyn, you have some things in the outer borough. What do you see happening in the market, and how hard is it for an owner-operator fund guy to do business today?
I think we have a unique advantage, all of us, that we were all operators and developers, so we can underwrite these assets from the bottom up, where a lot of these lenders that are looking to buy debt, they've never operated real estate before. So we have the unique ability to be able to act as if we are going to buy the real estate.
But that relates to the question. The question, you know, as I said to everyone before, yesterday I did this panel, credit crisis, and I had this one group, and I was nice on the invitation. I said they were specialty lenders. When I introduced them, I basically said, I was a hard money lender, and all of you are hard money lenders. Now, when I was a hard money lender, I didn't want to own. But some of these people want to own.
The distress in the market
own.
is the capital markets.
Yeah.
The underlying fundamentals are generally healthy, with the exception of the epicenter of the financial services in this area. But I think in general, the capital markets are where the most turmoil are. So you have this standoff of buyers and sellers that aren't transacting, and they're waiting to see what happens. And there's a lot of big deals in the market that people are monitoring very carefully. But the people who are selling and are transacting are the lenders. They've been told finally to start clearing out their balance sheet, bring in, you know, so that they can start, you know, clearing out the baggage and start fresh. And those are finally the sellers that are realistic.
And frankly, I mean, I think if you're sitting in the shoes that we are as fiduciaries, and you're looking at a choice, you're saying, I can get a 20% return, being at 75 to 80% of the capital stack, behind a great sponsor with an asset that, by the way, I've underwritten to own, and I would love to own at my basis, and I can still get a 20% return. And on the flip side, equity markets have not entirely repriced, and maybe you can only get 400 or 500 basis points more than that, taking development risk, market risk, maybe entitlement risk, the whole bucket of risks.
Yeah, so we haven't been convinced yet.
You know, we face that decision. We think, is it worth it for a couple hundred basis points more return to take all that risk? And I think at the current moment in the market, I think we're coming out on the side that we'd rather be on the debt side, but be prepared to step in and own the asset and operate it at a moment's notice.
And that all makes a lot of sense, and in fact, we're doing some of the same. We're right now pricing a loan on a development site that we really expect we're going to end up owning the real estate. But there's a lot of competition out there in that sector because a lot of the buyers of real estate today, a lot of the opportunity funds got their start in the early 1990s, and it was all about buying distressed debt. So they're very familiar with that whole game. They're now raising money, and there's a ton of money being raised. I think Blackstone went out and raised $10 billion to be prepared to buy debt, distressed debt, whether it's one-family house debt or multifamily or office buildings or retail. The market is becoming very populated. Our core strategy has always been to find value in the real estate, and there's going to come a time in the not-too-distant future where that strategy is going to start to play out. As we were talking before about where it's beginning to show, and it's beginning to show in land prices. Now, we're not going out and buying land today, but land prices are starting to correct because a lot of land that was bought in the last 2 or 3 years with land loans that had interest reserves with a business plan to begin construction in 2 years or 1 year or 3 years, those land loans are starting to come up. And you can't build today. You can't get financing to build. So there's going to be interesting opportunities, and that's where it begins. It begins at the edge with the land, and then it works its way back.
And it works its way into condos, and it works its way into people who have short-term debt, and they're getting rebalancing calls from their lenders, and they may not be well enough capitalized to meet those calls. Currently, lenders are forbearing because they may not want to actually recognize the problem. But I agree completely. I think it's only a matter of time before the next wave comes, and that's going to flow into the
So I have a question. Now that you become a fund operator, you were operators, will you do like regular funds who are like the Apollos, the Westbrooks, and the other people who aren't operators? Will you accept deals from other people looking to invest with you? I mean, are you only going to use the funds for yourself, or are you going to be joint venturing with other?
We do both. We primarily, our expertise is office operating. So on all the office deals that we own, we operate and manage.
But let's say I
have partners, operating partners for
Fine.
our non-office deals. So we have some hotels, we have some residential portfolios, and we capitalize and bring in partners that are going to execute the business plan the best. And so we have some very qualified, great operating partners that we'll align with. Also, if they have control of a deal and it's a part of accessing the deal and we've underwritten and think it's the right deal, we'll do that. But the vast majority of our portfolio and what our investors are investing in us is for operating expertise and the ability to execute the business plan.
We're actually looking at 3 deals right now with partners. We didn't think that would be part of our strategy, but we're not promoting those developers or partners are not promoting off of us. They're coming in straight up. What's happening is they can't find financing. So they come to someone like us who can help execute a business plan, help secure financing because we've got a bigger and better track record.
What's happening to us is actually the opposite, actually. Rather than us finding operating partners, these large, mega distressed debt deals where the fund allocators are looking for an operator to operate the investment if it needs to come back into equity, and they also want someone to put some real skin in the game. So operators like us are very well suited to be the operators of the fund allocators.
I mean, that's our experience. I mean, absolutely, we are continuing to do business with other pools of capital and with the allocators. We closed a deal last week that's exactly what you just described. We did a deal with Harbinger Capital, which is a $22 billion hedge fund. They brought us into a deal because they were looking for our operating expertise. So they put in 72% of the capital. We put in 28% of the capital on a deal. And it's a straight up loan, but if it doesn't repay, we have a fully negotiated operating agreement with them. If we take back the keys, it converts to an operating partner, capital partner structure, and we have a promoted deal with fees with them to run it. But only if it pays off, we all make money and go home. If it doesn't pay off, then they leverage off of our operating expertise to.
We're doing
run
the
deal.
same. We're doing the exact same thing on a deal with a capital partner. So yes, those sorts of things are happening as well, where the allocators are coming in and saying, you know, we want a well-capitalized operating partner,
Who thinks like us?
right?
Yeah.
And also has the operating expertise to step in should we
Exactly.
need that sort of expertise.
Do you see more operating people like you trying to start funds in today's market? I
There
know,
is a trend.
I know that Ramius RCG, who had never done it, raised the fund. And there are others. Do you see that happening?
Well, the environment right now is much, much more difficult for a first-time fund manager to come out. I mean, 2 years ago, I don't know the stat, maybe there's 400 funds that were first-time funds that were trying to raise money, and that has dramatically shifted. I mean, the investors out there are they want to consolidate their managers, so it's very difficult without a long-term track record, deep bench, to go out and attract institutional capital as a first-time fund manager.
I mean, until the recent correction, I would have said absolutely there was a trend toward operators raising direct capital, but I think it's tougher now.
In this credit crisis time over here, what type of products are you looking, besides debt, are you looking to, if you had an opportunity on a real estate, what would you like to buy or invest in real estate today in your marketplace?
Well, I don't know who mentioned it, but the underlying real estate markets are still pretty sound here in New York City, and in the boroughs as well. The residential market is doing, the rental market is doing very well. In the Bronx, we're seeing rents continue to grow. In East New York, where we have Meadowood, along with you, values are actually growing. The middle income homeowner sector values are growing. So the multifamily sector is very sound. The office sector, at the right price, the right asset, we'd be buying that. Retail and retail development opportunities and redevelopment opportunities in the right location make a lot of sense. And we'd be doing those sorts of transactions as well, even though the credit market or the credit situation is what it is and the availability of credit is what it is.
But the fact that you have more equity because you have the fund aids you to do it. Okay,
Here's a perfect example.
It puts us in a good position to be able to take advantage of today's credit market.
We're looking at a deal right now that was a Class A office building that was owned and occupied by a tenant that went bankrupt. And now the receiver is selling the building as a vacant office building. That's a type of situation that we would look to own, because number one, the seller is going to be reasonable and needs to sell at the market, whatever the market is. It's significantly going to trade significantly below replacement cost, maybe $100 a foot, and the competition for buying vacant buildings is very few and far between because the financing is not available. So funds like us can buy it all cash, show up with certainty, and get a reasonable price. If it's a strong market, that's the type of stuff.
I mean, a whole tier of buyers that were relying on high LTV financing is just gone. So there's much less competition for those assets.
In my articles and my other discussions, I've said that sellers have not become realistic, that prices have decreased. Are sellers finally realizing that prices are down? I think you said it on land, they are.
Yes, but only when being forced to recognize that prices are down. If you own property and you don't have debt coming due, you just wait it out. But if you've got the pressure upon you to do something, to transact business, you have to face the music. Prices aren't what they used to be. Right. If your yield expectations on your equity is 18 to 20%, and that was predicated on 75% debt, and now you can only get 50% debt, what gets affected? The variable is price. So that's going to play out over the next couple of years as owners that are faced with a credit situation that they need to deal with have to come to market with their properties.
I agree with that. I think the simple answer to your question in our experience is no. That I think sellers are being dragged kicking and streaming to that, and as long as they can put it off, they will.
Unless you have to sell, you don't sell.
No question. I mean, but the ones that are really in trouble, they're not even motivated because there's no upside for them to sell if it's below the debt. So they'll hold out even under duress, even with a short-term loan coming due, just to hang around for a hope note and let the lenders take it back if that's what they need to stay around for some management fees or some potential upside in the future. So it's the lenders that ultimately will get the property back that will be the reasonable sellers.
And maybe in many cases they're not wrong to wait, because if things stabilize, they may well at least have more value in 6 months than they have today.
Right.
But it's those that have equity, that don't want to put more equity in, that still have value above their debt, that are saying, let me get out, let me take what I've got off the table, pay off the debt and move on, rather than stick around and try to refinance and have to put up more equity. And there's plenty of opportunities like that. It'll be interesting to see over the next 6 to 9 months how it all plays out.
Michael, you'd asked before what opportunities are interesting. I mean, we've looked recently at a transaction in CBD Washington, an office building transaction in CBD Washington. There's a market, and we're all based in New York City, and we live and breathe the credit crisis and downsizing of financial institutions. CBD Washington
beats to its own drum.
I mean, it beats to its own
Washington.
drum.
What market? What credit?
What credit crisis?
What credit crisis? It's government leases. It's a great place. GSA.
Exactly.
That's why we like the Northeast, because each of the different markets, Boston, New York, and D.C., kind of act in their own independent cycles, and then it offers diversity and downside protection. When one cycle's up, the other one's down.
So, to conclude, I think it's going to be an interesting time for you guys. I'm happy that you've all raised in the middle of raising funds, and I know that 375 Pearl, the Bronx, and the other properties are going to do well. Jersey's going to resurrect itself. 8th Avenue is a great site, and I'd like to thank the three of you for being here today. Charlie Bendit, David Welsh, and Nick Meanstock.
Thank you.
See you next week.
Michael.
Thank you.